Charles Schwab is out with his 2024 outlook, saying economic pain is likely, but that doesn't mean stocks will struggle all year. The team led by Liz Ann Saunders and Kevin Gordon say that as we approach 2024, there has been no reduction in the recession versus soft landing debates. It's a key characteristic of 2023 and one which will persist into 2024 is the inverse relationship between Treasury bond yields and stock prices. Now, Seana, there were several things that stood out to me in their analysis, right? They look at consumer spending patterns and the relationship between consumer spending and what that means about the potential for an actual recession versus this idea of rolling recessions, right? That we've seen in certain sectors. And then just this, the relationship again between Treasury bond yields and stock prices. And then just in this particular cycle that we've been in, and the strength in consumer spending, which has had its roots, they say, in this massive monetary and fiscal stimulus that we saw previously. We know that echoes other commentary that we've seen with regard to the resilience of the consumer.
Yeah, in terms of what this call is saying, just in terms of what is going to drive the backdrop here for U.S. equity market looking ahead to 2024, they talk less really about the plunge that we have or the drop that we've seen in yields, maybe the potential plunge that we could see in yields looking ahead to next year, but triggered by significant weakening in economic growth. But instead, they're focused on the less volatility and more stability in yields and what that is going to do in terms of driving equities moving forward as we look into next year. In terms of where things stand right now, I think there's obviously a huge debate out there on the street about what exactly the gains next year are going to look like. And right at the top of this outlook here from Schwab, it said economic pain is likely in 2024. That does not mean that stocks are going to struggle in the entire year, especially there's this continuation of the rolling recessions that have hit the economy. So there are going to be pockets of optimism as we look ahead to next year. It's really going to be a winners versus losers stock picking type of market. We were just talking to BMO strategist here, Brian Belsky, earlier in the program. He has a 5,100 target on the S&P next year. And he was saying, hey, there's reason to be optimistic. You have to approach it as a barbell approach. Yes, there's still opportunity. There's still money to be made in technology, but you have to offset some of those high growth names for names that have not seen that rally so far this year. So a measured approach to the market in 2024 is one of these themes that are emerging from the Schwab note and really what we have seen across the board from so many of these outlooks for 2024.
Indeed. Another piece that stood out to me is just their focus on the consumer exhaustion. They headline the question mark there and where consumers stand with regard to savings and consumption. And they have this interesting chart, Charge It, which we saw a lot of that come out in the data that we've seen already with regard to consumer spending, especially when you think about the most recent spending holiday, which we've really seen this past weekend. But where consumers are, we're seeing an uptick in both spending on consumer revolving credit, right? We also seen an uptick on credit card delinquency rate as well. Not at the same level, of course, as where consumers are with regard to their spending on revolving credit. So there remains some strength, and we've talked to different analysts and economists about the savings levels of consumers across the U.S. And, you know, so we haven't seen a complete rollover in excess savings, and they point that out in their analysis and outlook for 2024, Seana.